fourth quarter of 2018 proved to be one of the worst for equity markets since the global financial crisis 10 years ago. Developed equities fell by close to 20% from the September peaks to late December. The US initially held up well until December, when the S&P 500 index fell by 9%, taking it to a negative return for the year. Very few assets produced a positive return in the year, and many equity markets entered bear market territory with falls of 20% and more from the peak. Emerging market equities also fell, but reached a nadir in late October, by which time the index had fallen by 25% from its peak in January. In contrast to equities, government bonds rallied, with the yield on 10-year US Treasuries falling considerably, resulting in a gain of 2.7% for the asset class in Q4. Other safe havens also rallied, including gold and the Japanese yen. Meanwhile, corporate bonds underperformed government bonds as credit spreads widened substantially from what were the tightest levels in several years at the start of 2018. After such extraordinary moves in markets, the Goldilocks environment, not too hot, not too cold, of 2017 is clearly dead and buried. The cause was a sharp and unexpected reversal in actual and prospective global growth, with key contributing factors being the ongoing trade wars between the US and China, and further moves by central banks away from ultra-loose monetary policy. Given this market backdrop, the Harmony portfolios inevitably fell sharply during the fourth quarter, with declines of between 4 to 7% in base currency terms for most of the portfolios. The Europe diversified and US dollar growth portfolios were laggards though, with falls of 8.8% and 10.7% respectively, which reflected the much sharper declines in European and US equities over the quarter, which those portfolios are strategically biased towards. In all cases, the portfolios held up considerably better than the respective local equity markets. On average, balanced risk profiles participated in around 50% of the local equity market falls, while growth risk profiles experienced around 70% of the falls. Although returns were clearly disappointing, the portfolios did benefit from us entering this unusually challenging period in markets, carrying the lowest levels of risks that we had held for several years. Throughout a period of very strong returns in previous years, we had progressively reduced our exposure to risk assets, most notably equities and corporate bonds, while increasing allocations to safe haven and uncorrelated assets to the highest levels in nearly 10 years, at close to 30% of balanced risk profiles and 20% of growth risk profiles. These changes all benefited returns over the past quarter and for the year. Our gold and US Treasury allocations all achieved positive returns over the quarter, of as much as 8% in the case of the gold-related allocations, while our liquid alternatives posted a modest negative return in aggregate, but protected very well versus other markets. While we recognise the many risks in markets and the likelihood that growth will slow from here, it appears to us that current valuations heavily discount much of this already. Markets have deteriorated by much more than the underlying fundamentals. Meanwhile, corporate earnings have been strong, most notably in the US, with growth of over 20%, which means equities offer much more attractive valuations now. It's easy to become very pessimistic about markets in this environment, but there are few signs of the conditions that usually presage a damaging recession. Growth remains positive and leading indicators generally point to further modest growth ahead, while inflation remains subdued and the collapse in the oil price will provide a useful boost for consumers. And although monetary policy has tightened, the Fed is close to the peak of its interest rate cycle, and rates globally are set to remain extremely low for some considerable time ahead. 2018 was clearly a very difficult year for investors, but we would continue to encourage a focus on investing for the longer term and staying the course through both good and bad times, given how volatile markets can be and how difficult it is to predict shorter term swings. The Harmony portfolios performed very well through 2016 and 2017, and a period of consolidation in markets seemed likely to us. From where we are now, we believe 2019 is likely to be much improved compared with 2018, and has the potential to deliver at least mid-single-digit returns for portfolios, albeit with bumps on the way. Following such a difficult year, risk aversion among investors is very high, and many are cutting exposure to equities and corporate bonds on the back of sharp falls. But as Warren Buffett famously said, it pays to be fearful when others are greedy, and greedy when others are fearful. By coming into this period cautiously positioned, we were able to capitalise on the falls in markets and the much improved valuations, and we did just that by adding exposure to equities in November and late December. We now begin 2019 with 4 to 5% more equity exposure across all portfolios, at a time when return potential over the next few years looks considerably better than a year before. But market moves in the past year have once again illustrated the benefits of true diversification, which will remain vital in the year ahead to withstand the inevitable bumps on the way through this extraordinary cycle. Our investment team continues to focus on building resilient portfolios with a wide variety of underlying return drivers, with equities at the core, supplemented with a wide range of diversifying asset classes, such as fixed income, property, infrastructure, gold, and liquid alternatives.